Welcome back to another episode of That Backyard Property Pod. I'm on my own for another mini episode. Today, we are tackling all things guarantor home loans. What does that mean? This is where a family member has a property that they can use as your deposit to purchase another property. This is such a common way for first home buyers to enter the market. Most family members do not have $50,000, $100,000, $200,000 to gift their kids to buy a property. How can they then help them? Because most parents want to help their kids buy a property. The best way is using a family guarantee. There's a number of different aspects in this area of the lending environment, and so I really wanted to tackle a few of those today. One of the common misconceptions is that the guarantor or the parent is liable for the full debt, the full home loan that the kids take out. That's not correct. Most banks are working off a limited guarantee. So depending on the amount of savings that the kid, or calling kids adult most likely, but the amount of savings that that buyer puts in will determine the limited guarantee that's associated with the property that's being used from the guarantor. So how does this work? If you are a first home buyer, any buyer at all, and you're buying a property, you do not need any deposit at all if you're using a guarantor. However, the more deposit you put down, the more savings you put in, the less the loan amount will be, and therefore the less the repayments will be. But you can still do this with zero deposit. So if you're looking to buy your first property, this is a great way to start. So depending on how much is the total loan versus the security value, so the property value of the property you're purchasing, it then determines how much the guarantee needs to be on your parents' property. The best way to work this out is you take the end loan amount, divide it by 80%, so divide by 0.8, then subtract the value of the property being purchased. So if you are buying a property and you have not got any deposit, which is fine because you can still do it, and you buy a property for $800,000 and you add stamp duty and other costs on top of that, which is then taking you to $840, really simple maths is you now have a home loan of $840,000, and so do it with me, but if you're driving, please don't. $840,000 divided by 0.8 is $1.05 million minus the value of the property you're purchasing, so $800,000. Therefore, the guarantee that the parents are providing is $250,000. So now when we're preparing the loan, we can, and in some cases have to, depending on the bank, have two loans. So in this case, you'll have a home loan over here that's attached to the new property of $640,000 because that's 80% of the value of the property, plus then a new loan that's over here that is going to make up the difference, and that's going to be secured by your property you're buying plus your parents' property. The best part about this is you separate the two loans so you can really focus on paying down the guarantee as quickly as you possibly can to get rid of them. How do we get rid of a guarantor? Not physically, but obviously the property. The guarantor can be removed at any point in time depending on the value of your property. What we're doing as part of Tusk is every 12 to 18 months, we will revalue your property to see at what point in time your loan amount is 80% of the value of the property. As soon as that happens, you can sign a form and release the guarantor. This is so important to discuss with your parents if you're broaching this subject, because they don't want to be attached to your home and home loan for the next 30 years. In Perth, especially because of the rise in the property market, we're removing guarantors every 2 to 3 years. So when you're talking to your parents about this, let them know that we've got a plan in place to get rid of them, obviously, but we want to make sure that the value of your loan is 80% of the value of your property. It can still be removed if that's not the case, but mortgage insurance is then applied. So now let's look at some common themes or misconceptions around a guarantor. Does having a guarantor increase your borrowing capacity? It does not. Unfortunately, your borrowing capacity is tied to the income you generate minus your expenses and liabilities. When a bank is looking at an application, they want to know two things. Do you have enough income to cover your expenses, liabilities, and the new loan? And then do you have enough deposit, savings, or a guarantor that you're not borrowing more than, in most cases, 95%, but in guarantor, 80% of the value of the property. So when you are using a guarantor, it does not increase your borrowing capacity unless, the big unless, if you are buying an investment property, so you're rent vesting, and we covered this off in a prior pod. If you're rent vesting, you can still use a guarantor. Westpac and Commonwealth Bank do this, and stay living where you are and use a guarantor and not pay mortgage insurance. In that case, your borrowing capacity increases because we can use proposed rental income plus your income towards the servicing of the new loan. So covering off two things there. One is your borrowing capacity does not increase with a guarantor. It can increase if you buy an investment property. And the other point to that is you can still use a guarantor if you're buying an investment property, which is really important. Why would you use a guarantor? The main reason is to avoid mortgage insurance. If you do not have, pardon any guarantee schemes and first home buyer benefits from the government, if you do not have 15% deposit, which you can do that with UBank will let you buy without mortgage insurance. Otherwise, you need 20% deposit and you don't pay mortgage insurance. Now, mortgage insurance is a cost that the bank will put onto you as the borrower if you do not have the required deposit amount. So the guarantee or using a guarantor removes this entirely, which saves you thousands. And it's a really, really good way to do this. I used this when I bought my first property. My parents helped me buy my first property, and that was fantastic. It was a great leg up, and I rented it out, and I used the rental income from the tenant. Whilst living at home, I also paid the repayments to get rid of my parents' guarantee as quickly as possible. So the key things on that aspect is the main reasons you're doing it is to remove mortgage insurance, plus you'll get a lower interest rate than if you're borrowing more than 80%. So let that sink in terms of what you're trying to achieve, because I do talk to a lot of parents and they do want to know from the kid, from their adult kids, what they actually want to do. How can I help? What can I do? I covered off another ways you can help as a parent or a family member, but if we're just talking about guarantees, the two main reasons you use one, no mortgage insurance and a lower interest rate. Now, what are the implications for the parent in this case? Well, using your property as security, if you already hold the title, so you've got no debt and it's unencumbered, then you're going to need to relinquish the title to the bank that's taking out the debt. The other thing is it will affect the amount of equity that you have if you want to invest in other properties or other asset classes. So you need to be aware of that. So it's going to depend on the value of your property, minus any loans you already have, minus the guarantee that's being put onto your property. So they're really important things to note. And the third one is if you are selling, if you're a parent, you're looking at selling that property, please don't use it as a guarantee because it really impacts what happens moving forward. Yes, you can still do it, but it does impact it. And so if you sell the property, that guarantee needs to be moved across to the new property you buy or another property you own, and not many people have two properties. So if you are thinking about selling your property and you want to help as a guarantee, we really need to tackle that one together. So please reach out with any questions on that front because that one is tricky. Last thing on this is, what do your parents need to provide to the bank? If we look at Bankwest, Westpac, Commonwealth Bank or ANZ, they only need to have your copies of ID as a parent, the copies of ID of the guarantor, and they need to understand where the income is coming from, what the current assets are and what the current liabilities are. The bank does not need any physical evidence of those numbers, but they need to understand it. You can still be a guarantor if you are retired. It's obviously not advice to do that, but you can still do that depending on the bank. If you're using a bank outside of those key ones, then you probably need to provide evidence of your income and sometimes liabilities to the bank. So I traditionally and I generally use those particular banks because it's easier for the parent. Now, if we use Westpac, for example, the guarantor needs to get legal advice. If we use the others, it's optional for the guarantor to get legal advice. Bankwest now introduced that as well. So Bankwest and Westpac, the parent or guarantor needs legal advice. If it was me, I would make sure that I was paying the legal advice for my parents to get that. It's obviously a cost, generally about $300-$400. So there's a few obstacles depending on which bank we use. In summary, is using a guarantor worth it? Absolutely. Less mortgage insurance or no mortgage insurance, lower interest rate. It does not increase your borrowing capacity at all unless you're buying it as a proposed investment, and then we can use rental income. Is there a cost associated with it for the guarantor? Yes. If you go with Bankwest or Westpac, they'll need legal advice. So there are different layers of requirements for different banks. As always, reach out because we can guide you as to what's going to be best for you in your particular situation. If the guarantor has a debt, then it's generally easier to go with that bank that they're with. But some banks will do a second mortgage, the likes of ANZ or CBA. So make sure you reach out because we can help advise as to which banks are going to be best for your particular situation. Thank you for being part of this community. Thank you for listening. Bit of a ramble today, but it's about guarantors and there's a lot to process. Share this with anyone that you think will need this, especially parents that you're trying to get to be a guarantor because they want as much information as they can get. Subscribe. If you're on YouTube and you're watching this, subscribe. If you are on Spotify or Apple, then like and share this and follow because I love having you a part of this community. Have a wonderful weekend and I cannot wait to see you next Tuesday when we release the next episode. Until then, cheers.